We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is episode number 92 of the Finances podcast. Take two, Ben. How many times have I forgot to press record?
Oh, I thought that was the first, but anyway,
So
here we go.
We were 5 minutes in, not quite. So today our guest is Jonathan Tolub from InvestSense. Jonathan's director at InvestSense. Jonathan, thanks for joining us on our little podcast.
My pleasure.
Feel like you've said that before. Now, we're going to have a separate podcast where we give your backstory and a little bit more history on InvestSense and the work we've been doing with you over the course of the last 12 months in building portfolios for our clients. But for today, we're at the back end of our investment committee discussion. We've got a bunch of questions that we're going to throw at you based upon the chat we've just had. So let's roll. Benny, you can start us off. Ask JC a couple of questions about what's happening in the market at the moment and thoughts around where client portfolios are at.
Good question, Jay, of me. All right. I suppose, first of all, and we could talk about this for 2 hours, but we'll try and keep it short. And
we actually did.
We just did
for 2 hours. Yeah.
Very good point. I suppose, again, let's just use the word to start with inflation. So that's sort of the topical thing. We've just spent a fair bit of time talking about inflation, deflation, how we sort of sit in the middle of those risks at the moment. I suppose give us a little bit of an overview of where we sit at the moment and maybe the risk of either side.
Sure. So let's start with the good news. The good news is we actually, at an Australian level and even at the global level, in a pretty good situation economically, where inflation has moderated. So we used to have an inflation problem, and it's slowly but surely coming down. We have still economic growth that is quite positive in Australia and globally. So when you look at the situation, not looking at the context outside of that, things are looking pretty good, right? What's unusual about the current situation is, in our opinion, how close we potentially are to a problem. And more specifically, we could potentially fall back into an inflation scare like we had 2 years ago, and we're actually not that far away from it. Right? We only need to change a few things in order for us to fall on that negative scenario. On the other side of it, the almost opposite scenario, which is a recession, is also not that far away. And so a lot of what we talked about and what we do is trying to keep an eye out for signs that could indicate that we're potentially falling on one side or the other. But just to refocus on the good news is things appear to be relatively good. The base case scenario is that things continue to be good for the time being.
I think a nice positive sandwich. And I suppose what we have to do is and what we talked about a lot is government interventions and how they go about maintaining us in this nice sort of happy space that we sit in. Yeah, we probably spend most of the time talking about the US, which is pretty much what dictates what happens globally. So I suppose one of the things we spoke about there was about them pulling a lot of different levers to sort of try and keep things stimulated without overheating things, especially in an election year. Can you just touch on, again, without going into too much detail, how they've sort of continued to do that? And I think you said over the last 20, and then you said maybe it's been the last 30 plus years, how they continue to do that.
That's right. I don't want to go too much into the history of it, but typically that type of policy is associated with Alan Greenspan, who was the head of the Fed prior to the GFC and into the kind of the 90s and after. And his thesis was that, there are cycles to economy and to financial markets, and the job of the Fed is to flatten those cycles, to make the ride a lot smoother. And they've been very effective at doing that. And even when you think of the big crisis that we had over that period of time, like the GFC, like COVID, the intervention from the authorities and primarily from the central bank was very strong and really helped the economy and markets pull out of a hole in a relative quick time. What we talked about is that there are long-term consequences to that. And what's become more and more apparent is that inflation is probably one of the negative outcome of those policies. And probably one of the reasons that we had inflation, 2 years ago is because of the response to COVID by the authorities, being either the government or the central bank. What we're worried about now, when we're talking again about those negative scenarios, is if we start seeing the economy weaken a little bit, that the central banks and the governments will have the same reaction function and will start intervening right away, and thereby planting the seeds of another inflation scare, if you will. And as you can imagine, as you add up all those interventions, probably the threat of inflation is adding up as well, and the next one could potentially be, as strong or even stronger than the previous one.
And then that leads to the difficulty of being maybe a little bit frightened and people being on the pessimist side of things is to not be involved in those markets, is sort of anticipating some major reaction to this. And as you probably said, this has been going on for decades already. Maybe it's something that's short term, maybe it's something that doesn't happen for another 50 years. So we have to continue to be involved in these markets and continuing to be invested, but with balance. And I suppose maybe back to more of probably our philosophy, Jay, longer term, which is paired now with JT and the team at InvestSense, is about just being balanced across the board.
I think one of the concerns when people hear things like on a nice edge, people generally think very immediate and think very tactically about, well, what are the immediate changes that I need to make? And the balancing act, or the dichotomy for us, is to balance out those short-term decisions that need to be made in terms of adjustments to portfolio, but also educating clients long-term that being in the market is a really important part, and not being too, as you said, too pessimistic about what maybe some of the short-term risks are. And I think to the point of actually having the expertise we now have with JT and the InvestSense team on board, it allows us to actually make some of those decisions rationally. And again, I think we as a business and with our clients have been particularly good about educating them on the importance of that. But this just puts, I suppose, more granularity around what changes we should be making in our portfolios. So maybe talking about some of at a broad level, what are some of the themes that you're seeing in terms of the areas that we should be in and out of, or increasing or decreasing exposure? And maybe we focus more so on sort of our client portfolios and what we're seeing.
Yeah, absolutely. So I know we're going to devote another episode to kind of more of the methodology that sits behind the portfolio construction. But in a nutshell, because it's almost impossible to address that question without answering that first, all of the things that we spend quite a lot of time talking about, what is our view on inflation and economic growth, and what could the Fed potentially do, and the RBA here, etc. Those things are important to look at, to study, to have a good understanding. At the end of the day, though, our ability to predict those things is, toss of a coin, basically, right? So I think we need to do that work in order to be aware of what are the potential scenarios, what is the base case scenario, what are the tail scenarios, what could go wrong, etc. But that's not so much of a driver of a long-term portfolio construction. And what we rely on when it comes to building portfolios is much more objective data that is numbers-driven, less opinion-driven, and gives us an indication of not so much what's going to happen in the next 12 months, but more what will happen over the next 10 years. And that could be a bit counterintuitive, but it's actually a lot easier to predict what's going to happen over 10 years than over 1 year. Now, going back to your question, what are we doing within the portfolios is when we look at the data, what we're observing is that there are certain parts of the market that seems a lot more attractive, meaning have a higher expected returns over the long term. And those are essentially Australian equities, and that's good news because we're based here and we tend to have a large allocation to Australian shares, and a lot of things outside of the US, right? So we tend to have at the moment in the portfolio an underweight to US equities. So think, the Google, Nvidia, and Microsoft of this world. They're good, great companies. They're growing fast, but you need to pay too much for it. Right? They're a little bit too expensive currently, and therefore the future expected returns is likely to be lower. On the other side of that, you have economies in emerging markets that are growing fast and are also cheap, right? And you have the same things happening in Europe, not so much the growth, but more the attractive valuations, how cheap you can access those companies. The same thing happening in Japan, in the UK, etc. So our portfolios are a little bit tilted toward that, underweight the US, overweight the rest of the world. And that's one of the big active positioning within the portfolios currently.
I know we're going to do another podcast on this, but we talk a little about relative risk over a relative period of time. And that's one of the things, it's been one of the very formative things for our clients and also for us about the sort of the methodology that you use to make the decisions, and the fact that the risk appetite, the risk we expect in particular sectors floats all the time, and that you are constantly looking at where the risk is versus the time frame that we expect that risk to occur. Yeah, I suppose it's more just making the point that this is it's something that we as financial advisors being able to bring that expertise in, because we sit in client facing much of the time. And being able to have that expertise sitting behind us is comforting, and should be comforting for all those people out there, clients and otherwise, that want to, think that we should be actively making changes to portfolios based upon that risk, but also understanding that risk.
I was going to say, I think there's the two sides to it. It's understanding and monitoring all of these constant changes in the indicators and markets, but It's then knowing when to not react and when, but also when change needs to happen. Like I think some people assume that it's almost an intraday trading scenario because there's so many things happening. Then it's not to be completely passive and just not respond to them, but it's just about knowing when to just adjust just a little bit. And I think the easiest way maybe to understand that, say, inside of the direct Aussie portfolio. So if you think about a couple of examples there, like, we just spent some time talking about maybe a Wesfarmers, and it's run ahead. So you look at it internally, it's probably overvalued at this point in time. Maybe it's a good opportunity to skim a little bit of profit out of something like that, and then look at something else that's, maybe that looks good value at the moment. So using all those sort of leading indicators from a global perspective, macro economy, back into the micro to make changes.
Yeah. And the example you described is almost an ideal scenario, which you invest in a company and it's a good quality company and then it performs well, and taking profits on it or selling it, not because it's become a bad company, but becomes, in a sense, it's become even better, right? And so you're taking profits, and then, that's such a good situation to be in as an investor, which is, look, I've made some good money here. I don't need to buy at the bottom and sell at the top every time. I don't really care if it goes higher from there because I made good returns from it, and I'm reinvesting those profits into another company that is also a good quality company, but is actually available at a much more attractive price and that therefore has much more upside.
It's the really hard one for people to overcome, is the emotion around that. And even a well-known business like a Wesfarmers that people interact with all the time is that they think, well, I don't want to get rid of that. It's going to be around forever. Yeah. But then if you best be completely rational and use the numbers as the indicator, well, it's expensive. I can buy something that's got better upside at a cheaper price. It doesn't mean you don't go back to Wesfarmers at another time when it becomes the more favourable option. And I think, again, it's probably an Aussie thing, I think, is we're quite loyal to our investments as well. So that becomes even more challenging. And we've had lots of discussions and we've talked about this on the podcast many times before. But just being able to overlay that situation, have it, use the numbers to dictate what we do, super important. Take some emotion out, often drives poor decisions.
Objective data. You like that, don't you, JT?
Absolutely.
You mentioned the sell positions we used the example of Wesfarmers. The other thing that we talked about for a little while today was opportunities in the market, stuff that isn't in our portfolios. We don't own it at the moment. And you had a couple of examples. Thought maybe we'd just touch on IDP education as an example of what you're looking for in terms of opportunities in the market, maybe that we don't hold in our portfolios that have some potential upside.
Yeah, sure. So I'm going to preface that by saying that, look, I love to tell stock stories. It's always nice and appealing. At the end of the day, what matters more is the overall portfolio, the fact that we hold 31 stocks in a portfolio, and it's, how that ecosystem evolves, basically, that is important to us, right? So within that portfolio, we're going to have some growth stocks, we're going to have some value stocks, we're going to have some dividend payers, we're going to have some turnaround stories. The important thing is to be diversified across various risks. So if one thing happens here, you're not overexposed to it. Now, having said that, IDP Education is a company that is in the student placement business. So it matches universities with overseas students that are looking to study abroad. So by and large, it tends to be Asian students that want to study either in Australia or in America. And IDP Education matches the university and students, so provides services to both, and I think also provides services afterwards, after the placement, to the students that are abroad. It's a company that has quite a nice growth profile, has been able to grow earnings on the back of, quite obviously demographic trends in Asia that, with a population that is moving into the middle class, becoming more wealthy, and more and more people that can afford the luxury of an overseas education. Now, what always matters is not just the path of the earnings, but again, as we discussed, how much you're paying for it. It was a company that was quite expensive even about 2 years ago. And part of it was because it's a bit of an ESG darling. So people who invest in primarily with ethical mindset are very attracted to that company because it kind of ticks a lot of boxes from that perspective. There's been a little bit of a downturn both in ESG investing and potentially in the growth paths of IDP Education. And so the outcome is that it's now a lot cheaper than it used to be, right? If you look at kind of peak to trough, it's probably 30-40% cheaper than it was at the top. The fundamentals are still strong. The long-term story is still attractive. So we see it as an opportunity to buy a growth company at a much more attractive price. Now, having said that, maybe that particular company, which is one of 31, is not going to work out as expected. The important thing is that we have others in there.
I'm glad you added the preface or the caveat there, because I think one of the things that we notice with clients is that clients love stock stories as well. And part of the education piece and why it's so important to talk about diversity is that you think about the number of stocks that exist in our client portfolios, the ability to be over the top of all of them all of the time is very difficult, even for an individual investor. And it's kind of the combination of the diversity that we educate our clients that we know we need, but also with the intelligence and the research behind it. You combine those two together and we have the performance and risk mitigation that clients really desire. We got time for one more question, Ben?
If you want.
Okay.
Very quick one.
We talk, for those, this is probably more for our clients that understand how our portfolios, starting to understand how the portfolios work. And we have a number of portfolios that have a return plus CPI. You mentioned, and correct me if I'm wrong here, but you said that with relatively good conviction, the outlook for inflation over, say, a 10-year period it sees it reducing from the period or from where it is at the moment. So when we talk about the sort of CPI and the increase in the cost of living, there is relatively good conviction across the board that inflation will come down over the longer term. Is that a fair assessment of what we talked about?
Yes, but it is, right? That inflation being currently, I think the last number is around just above 4% in Australia. And when you look at the long-term market predictions of where inflation is likely to be, it's more kind of the mid-range of the RBA target, which is between 2 and 3%. So let's call it 2.5% currently, which means that the market has a confidence that over time, inflation will come back into kind of more historical norms, and that a high inflation, we may have spikes, but if you look at a 10-year period and average over those 10 years, it's very unlikely that we'll have such high inflation numbers, right? Now, that in and of itself is good news because, as you mentioned, the portfolios have a CPI plus target, so CPI plus 2, CPI plus 3. Obviously, it's a little bit easier to achieve a CPI plus target if the CPI component is as you expect to be. And that's a big part of the good news today, which is when you look at the expected return at a portfolio level, today it looks like all the portfolios that we manage have a fairly high probability of achieving their objectives with even a little bit of a buffer there. And I think that overall, especially when you contrast that to what we were talking about earlier, what are the risks, inflation, recession, etc. Keep in mind that those things don't last for 10 years. They're inevitable part of the journey. But when you look at the entire journey, actually at the moment, it is quite a positive story.
Thanks, JT. Ben, any closing comments?
Last nice positive ending.
Yeah, it's a good way to end it. Listen, we did talk for 2 hours prior to the podcast. We're trying to condense that into probably 15 minutes. But we'll look forward to making this a regular thing, JT, after our investment committee meetings, actually recapping. And thanks again for your time. Appreciate your expertise. And I know that our clients, as they get to know you and get to know the InvestSense team and what you do, will very much value these discussions and the recap on markets and where we're headed. So thanks, Ben. Thanks, JT. And we'll see you next time.
All right, thank you.
Thank you.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.